Oh, so now you come back from your holiday. How does anybody have long holidays like it? Buonasera, signor Ingrama. How was Italy?
It was very nice. It was great to see. It made me think that actually, if you go around, I went to 3 of the big Italian cities, and they've got lots of history, and it's beautiful, massively overcrowded with tourists, but their public infrastructure really is struggling. Their roads are in, I think, really bad condition. The cities are the actual cities where Italians live, not the parts that we see, are really tough places. And we always tend to put the rest of the world on a pedestal, and I think we do live in a beautiful place, and a lot of our infrastructure, I think, is a heck of a lot better than what's going on certainly in those Italian cities.
Okay, that's your assessment of your holiday. So he went on holiday and he did an economic assessment. What a sad creature. Now I've got a question for you this evening. What has been the biggest faller on the JSE year to date out of the top 40?
I would have said Naspers, but I think I'm wrong.
Naspers started falling toward the end of last year. You might have been trapped into thinking Steinhoff, but Steinhoff did most of its falling, and it's no longer on the top 40. Steinhoff did most of its falling in December.
And it's a top 40. So, so let's go with the financial.
Which one?
Well, I know the answer already.
Okay. Capitec, down 24%. Discovery down 22.5%, but it did have that huge run up toward the end of last year. And then MTN down 23% and Vodacom down close to 20%. Huge fall in massive companies.
And really well run, brilliant, innovative companies. If those names that you're mentioning are some of South Africa's very best in terms of being able to penetrate new markets, new ways, and to look at those drops are really significant, especially in the context of the JSE, which is not down nearly as much.
No.
And you can argue a lot of those businesses have done nothing wrong. There could be question marks about Capitec with the Viceroy report, but that's not that they've done something wrong. But for the rest, how would you say that those businesses have failed?
And here's the weird thing is that the vast majority of the gainers, and there are not many gainers year to date, they're 3, 4, 5, 6, 7, 8, 9. So a quarter of the top 40 have gained this year. And most of them are resources counters because the rand is weaker and some of the underlying commodities are stronger. It's not because they've done anything particularly. They're wonderful people and do great jobs, but they've not done anything particularly brilliant in their own right.
Well, it's a really good sign actually for the South African economy because we still are, whether we like it or not, still have a big resources component to what we do, and I know the rand's weak now, but to some extent that's been an explainer of why the rand really did strengthen over and above our politics was around resources. And it's a good sign for the global economy, the actual fixed physical economy of the world. When resources are going up, that means people are building things and things that will be around for a long time.
Yet, stock markets, China is down about over 20% over the last couple of months. A trade war talk, Donald Trump putting higher tariffs on Chinese imports, the Chinese responding, the Europeans getting very nervous, Harley Davidson having a slanging match with Donald Trump, moving production of some of their models back to Europe for that particular market, and Donald Trump calling them idiots and they called him a moron. All of this noise, and in South Africa we've got a mining charter that the mining sector sort of is grateful isn't worse. We've got NHI, which not even the health minister who drew it up knows how it's going to be paid for. And we headed towards an election next year with the political parties all bickering amongst themselves as to what the future should look like. And that's internally and then with each other. And you just go, I want to hide somewhere very safe with a warm, milky drink and maybe a chocolate bar for 6 months, please.
I feel most comfortable now. I haven't felt this comfortable for probably 3 or 4 years. I think,
and when you say not because your pants have got a stretchy waistband and you've just come back from Italy,
because I've had too much chocolate, no.
Exactly, or too much pasta. But you are more comfortable from a valuation perspective. Markets were quite hot and a little bit overexcited and a bit frothy, they've pulled back quite sharply.
And I think we still have to see a proper pullback in the American market. We haven't seen that yet. So that still has to come. I'm sorry to say for those that were expecting the market to boom, the US market to continue booming this year. But I think expectation is always the thing that really worries me the most in markets. When we are all really complacent and expecting things just to carry on booming because we had synchronized economic growth, etc., that's the time when I'm most worried, because those are ripe grounds for a major crash. Now, it could still happen, but the probability of a big crash gets less and less and less. That's not to say that investors aren't extremely nervous and that they have a right to be to some extent, but it is probably time to look at some safe havens and some safe harbors.
Okay, so you're not suggesting for a moment that we just don't open our statements or go to the website of our product providers or our unit trust providers, or to go to look at Satrix on a daily basis. We'd stop doing that and just ignore it and wait for things to turn. You're suggesting we do take some action.
I think on the JSE specifically, you can, for your exposure to the market there, you can probably do that, because I think that broadly the market's in a reasonable value now, except now, I suppose. But on the global side, I think investors should be looking at what they've got overseas, because a lot of the time they're probably dramatically overexposed to the American market and very underexposed to emerging markets, especially now, as you say, that China's down as much as it is. So I think it is worth reviewing and so just to talk through what happens in a time like this. Investors do get really nervous and they start to look for alternatives. They start to look for ways to kind of find the safe harbor. And traditionally there are a couple, so the first one, and we've just spoken about resources, and that's a classic. Investors go to investments like gold and silver and platinum, so physical commodities, and they go there because they think if the system collapses or the markets take a huge knock, that's a place to be, or if there is a threat of inflation. Employment in America is at all-time lows, and if you're getting wage
all-time highs, and unemployment at all-time lows, employment, it's like unemployment.
No one's looking for a job
4%.
in America.
No,
if the people that don't have jobs now are choosing not to have jobs.
No.
And so in that situation, there is a threat of inflation, and that's why you buy commodities. And that's not a bad thing to do if you've got a really well-spread, well-diversified portfolio. I wouldn't have much more than sort of, 5 to at really worst 15% of a portfolio. 15% is a huge amount, I think, in a commodities exposure. And you need to know that that's not a long-term position, because commodities don't pay you interest or dividends. They require someone to be more fearful than you to pay you more for what you paid.
Somebody's going to say, what about cryptocurrencies? The prices have come off so nicely. We've got Bitcoins trading at $6,300 a pop, which are at a third of their highs in December of 20,000 Rand. You ready to double yet?
No, not yet. Not at all. And one of the things I did overseas was go to a global fund management conference and just listening to a lot of really smart people about cryptos there. I think, its time is coming. But if you're looking for a safe haven, the very last place you put your money is in something which can move
in an experimental technology. Yes.
Yeah, and it's something that can move at 30 or 40% in a day or two. Forget about a month or three. So I don't think I think that's still a speculative asset. It's not something that gives you a safe haven.
I know you're averse to cash and you'd like to be invested in markets and growth assets, but is there a point like now? And then you're going to respond and say, but at what point do you invest? But to sit in some cash.
There is, and more internationally again. So I think, I have for the last few years been very worried about buying international bonds. So if it's good for your asset allocation, that you should have some exposure to international bonds. I've been very comfortable to take that part of my exposure and just keep it in cash, especially now as interest rates are rising in America and are going to continue to rise. I think it's not a bad call to hold your cash there until that cycle sort of starts to peter out, so they stop raising rates, and the Fed have been very good at telling people that what they're going to do. So then I think you could hold cash until that's done. But But if you've got money that you need to allocate to the US market, for example, then to keep it in cash now and feed it in over long periods of time, and I'm talking 12 months or more, is not a bad thing to do. So yes, I would hold cash, but I'd be doing it for a purpose and then feeding it in.
One of the greatest traps that people fall into is they go, oh, markets are too scary. I heard that guy Warren Ingram on the radio say markets are scary right now. So let me put cash in the bank. At least I'm going to get, 5% interest, and then my 100 will go to 105. And then when I'm more certain, then I'll put it in the market and I'll start investing again. And it's the biggest trap for everybody who does that.
Absolutely. The certainty, unfortunately, only arrives after the market's had a nice recovery and everyone's feeling fabulous about the world again. And by then you've missed out on that jump. So, for example, with South African cash, we know interest rates are probably going to stagnate for a while now. I think, there was a chance that they would have gone down a bit further, but I don't think so anymore. And so I think, to hold interest where you're going to pay tax and not get much return above inflation doesn't make a lot of sense to me. And again, unless it's for a specific purpose. But with the JSE at these levels, we're certainly not by any means in super expensive territory like the US market is. So I think if you've got money that needs to go into the JSE, put it in, but maybe feed it in over a few months.
Warren Ingram from Galileo Capital. You do remember your passcode for the office door?
I forgot my passcode for my computer this morning.
Did you?
I did.
Great holiday. Warren Ingram from Galileo Capital.